Welcome back. Almost at that 19,500 mark, and it's courtesy HDFC Limited and HDFC Bank. These two heavyweights are pushing higher. Remember, this is the last time both these stocks will be there for the Fin Nifty expiry, the weekly expiry which takes place, and the record date for the merger between HDFC Limited and HDFC Bank is 13, which means you can trade HDFC Limited only today and tomorrow. And these stocks right now are pushing higher, almost at 14,500, and the advanced decline ratio is still holding very, very strong. But let's get chatting about the way forward for our markets. We've had a record-breaking up move in the last couple of days. The Nifty's climbed to levels of 19,500. Where do we head from here? Who better than Sunil Tirumalai, the Executive Director, GEM Equity Strategist at UBS, now joins in. Sunil, thank you very much for joining in. The last 3 months have been very, very strong. But if I look at the performance on a year-to-date basis, the Nifty is up close to about 8%. But it's trailed the kind of rally that we've seen in other markets in Asia. Nikkei is up 23%. You've got the Taiwanese markets up 20%, and so on and so forth. The rest of the emerging markets have actually fared better than India. How do you rate India versus the other emerging markets? Because that will also determine the kind of flows we should expect going forward.
Thank you, Ima. Good morning to all your viewers. Yes, I mean, you're right. India actually went to a fairly bad start beginning of the year, and we've kind of managed to catch up. I think when I look at India in an emerging market context, you're largely in line with the index. Some of the markets that you mentioned have been extremely strong this year. I think if I look at take a step back and look at, let's say, a 3-year history and a 3-year forecast kind of a view, what we notice is that India's top line growth, margins, earnings are all fairly ordinary. I mean, Indian corporates generally stack up in the bottom half from a 3 to 4 year history period. And even if you look at forecasts, right, 2024 calendar year, there are quite a few other emerging markets where the sell-side expectations are much stronger than for India. So
can you give us numbers?
I would say hello?
Yes, can you give us numbers? How the earnings growth picture, the forecast?
Yeah, so for the emerging markets index, the last I checked for 2024, you're talking about something like 18-19% YOY growth, led by large markets like Taiwan, Korea, China, some of the ASEAN markets, etc. India is somewhere in the 14-15% range, right? I mean, that's the kind of usual growth rate that you expect, and that comes on the back of the last 3 years as well. India being kind of underperforming the rest of the emerging markets on earnings growth. Right, so I think so that's the context in which I would like to see that we've seen a massive rally 1 month, 3 month basis, but of course that's kind of catching up on what we lost in the first half of the year. But if we look at what the outlook is, where India stands versus other markets, and where the valuations are, I think the upside is kind of limited. I mean, we've done this fairly simple exercise where we're trying to see if I take any average EM stock, a randomly chosen EM stock, and list it in various markets, what premium or discount comes up, i.e. just because it is an Indian listed stock or a China listed stock, does that mean a premium or a discount, all else being the same? And as we speak, the premium for India is actually 70%, right? So pre-pandemic, we normally had about 20 to 30% premium, which is the India premium, which can't be explained by the growth of the companies, ROEs of the companies, etc. And that number has gone up to about 70%, right? So I think this is where, I mean, a lot of the narratives have probably already got priced in, and we don't see too much of upside. So so we have India as an underweight in our EM universe.
Okay, hi Sunil, thanks for joining us. That actually brings me to my next question, because like you mentioned, you are seeing good earnings growth in a lot of the other Asian markets, perhaps better than India as well. Valuations in India, are expensive, always have been. What then explains the kind of flows that we are seeing into India, FII flows? And do you think, since you're saying that the upside is perhaps limited, do you think the FII flows are likely to dry up?
Yes. So, I mean, I think, as I said, there were concentrated outflows beginning of the year, because of adverse news flow on a particular corporate group, and if you actually break down the flows that have come in over the last 3 months, 3 to 4 months, a lot of the flows are actually, I mean, more than half of the net inflows last few months can actually be explained by the flows from a particular foreign investor into that group, right? But having said that, I mean, there's no denying that India has seen a significant reversal of flows. I mean, a few factors have contributed to that. I mean, the recovery in China has been a bit disappointing, and there have been a few geopolitical issues, and hence India has benefited from money that probably went out of China as well. Again, even on a flows perspective, if I look at it from a YTD basis, either in absolute terms or adjusted for market cap, India is not even in the top 4 or 5 among emerging markets, right? So it's a recent phenomenon of significant flows which have caught up for what India lost at the beginning of the year. I think going forward, because of the fact that India is looking quite expensive, even in our conversations with investors, we do see questions like, I think at a market level, it's difficult to take a buy call on India. Which are the specific sectors or stocks that still make sense given where the valuations are? So I think we're probably closer to the time when the big flow divergence that India is seeing versus the other markets for the last 1 month might also start to stop.
Sunil, hi. So just to clarify, your own call, the house view at UBS, are you underweight India or equal weight?
Underweight India in the EM universe, yes.
Got that. Okay, so I just want to focus on another interesting aspect of this report on flows, and that was on the retail side. Just trying to understand this, because we've also been noticing this, right? The last couple of months, even in terms of flows coming in through mutual funds, have been muted. Yesterday, we got the numbers for the previous month where there's a pickup. Now, I think the monthly equity flows were at least 8,000 crores plus. But your report seems to suggest that retail interest is actually drying up despite this 3-month rally. And maybe it's not even, forget mutual funds, the direct interest in terms of direct equity, that's also cooling off. So can you just elaborate on the findings there?
Yes, I mean, I think the way we approach this topic of flows is that, I mean, in the market, for every buyer, there's a seller, right? I mean, usually people focus on FII flows or DII flows. A very big missing part in that is retail flows, and then people don't talk about capital raises. I mean, all of them are part of who buys and who sells in the market. And our attempt is to basically use a lot of data to try and understand who's buying and who's selling, right? And that's the title of the report. So I think in the latest edition, so I think basically what we are finding is that in the September quarter itself, direct buying in the market had actually turned a bit negative. I think in the December quarter it had, and in the March quarters it had actually started stabilizing. It turned a bit positive. But I think again, if you look at some more recent data, we are seeing reasonable net selling by retail investors in the market, right? So this is something which isn't so easily available as a data point, but I mean but I mean that is the rounding off figure when you know what is FII, what is FDII, what is what are IPOs doing, what capital raises are doing, etc. So when you look at flows into mutual funds and flows from retail directly into the market, to me they are both coming from the same source, which is households allocating their savings towards the market. And at an aggregate level, for the first time since December 2020, we see that this has actually come off. Now, even on equity flows into the equity mutual funds, I think a lot of limelight goes towards the SIP culture in India, and it's like a fantastic practice and behavioral change that's happened. That's really good for the markets and for our industry. But at the end of the day, SIP linked AUM is less than 15% of equity mutual fund AUMs. Right, so there is actually a fairly large non-SIP portion, which can be lumpy in terms of coming in and going out, right? And I think what we are seeing right now is that the non-SIP part is actually becoming big in terms of selling, and hence the net flows, are also, kind of, becoming a bit soft. So our assessment is at an aggregate level when we look at, retail buying and selling into the market, plus the retail flows into the mutual funds. We are probably close to zero or negative, right? I mean, the other way we looked at it, I mean, because we're actually having fairly rich stock level data, right? For every 100 rupees that retail investors have directly invested into the market, we probably feel, they're sitting on losses of 20 to 25 rupees, depending on the kind of stocks they've chosen and the timing of the, buying in and selling out of stocks. So at a time when, something like a bank deposit rate is giving you a reasonably healthy return these days, we find that there's an economic logic for, these flows to remain weak.
Sunil, out of time, but thank you very much for joining in. At a later date, we'll try and get you on the channel to talk more about how one can construct their portfolio in order to make the portfolio resilient in the event of any downside. Thank you very much for joining in. Get into